You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. So last week we took a week off from strategies and we answered some listener questions. So this week we're going to jump right into it because we are in the heart of the FANGs earnings season. And I think it's fitting considering that Halloween is right around the corner. Might as well talk about the FANGs earnings. I think that goes hand in hand. So the two big ones are coming. Today we are taping Options Playbook Radio on October 24th. It is a Wednesday. The market has closed. The market tanked today. The VIX index is north of 25. And a lot of the indexes were down 2 to 3% across the board. So with that said, a lot of the FANG stocks were the stocks that brought it down, to be blunt. So we have two stocks that we're going to look at because they're announcing tomorrow, and they're the two biggest ones. We have Alphabet, otherwise known as Google, and Amazon. Now, the Google that we're going to look at today is the extra L, GOOGL. That stock closed at 1,057.12. It was down 58 points, if I round off a little bit, today. And Amazon is the other stock we're going to look at. And that stock was closed at 1,664.20, down $104.50 on the day. Now, funny thing about that is that's almost the expected moves that they are that the marketplace is implying after earnings. So obviously extremely big moves in these underlying stocks, big moves in the marketplace. It's a scary time to be doing some trades around earnings because there's enough volatility in the marketplace as a whole that you don't necessarily need to be thinking about, well, what's going to happen to volatilities after earnings. So with that said, on Options Playbook Radio, everything is just meant to be learning. This is not meant to be a recommendation, especially in this time frame, but I do enjoy looking at these high-priced, highly traded FANG stocks that announce earnings with 1 day remaining until the expiration date in the weeklies. So basically, they're going to announce after the close tomorrow, October 25th, and you have 1 day for the Friday options to trade, and then they expire. And so you have all this time premium that is in both of these options. First of all, because you have a high-priced underlying. Second of all, because they're announcing earnings. And third of all, the market's just going crazy. So all that time premium has to go away by the end of Friday. So you're really something's going to happen if you put on the trades. And the trades that I usually will go to and we'll talk about if you look at previous shows are skip strike butterflies, something that wants time premium erosion to happen. Those are some of the more common trades. If you think the market's going to be more volatile than what the expected move is, then you want to look at a back spread, something where you're looking for more volatility than less volatility, or you could just stick with the good old fashioned long call spread, long put spreads, just to take a flat out bearish or bullish shot. But you have to sell premium in these underlines if you're going to trade them. That option strategy has to contain a sale. Preferably you want something that will have a positive theta as time goes by. So we're going to have something here that has positive theta, which means we want time to decay. But we're also going to have these trades, the butterflies in particular, where it will also have a negative vega, meaning you want implied volatility to come in. I mean, they're basically the same thing. As far as time premium is concerned, there's always a percentage of that time premium that is implied volatility, and that is actual time. So with that being said, let's get right into the strategy. The first one that I brought up was Google, and I have no opinion on direction on Google or Amazon. And basically, I don't want to have an opinion. So I'm just going to flip a coin, and I'm going to go bullish on Google and bearish on Amazon. No particular rationale why, but on Options Playbook Radio, everything is meant to just be a learning experience. So let's do one bearish and one bullish, and then we can come back and review them next week and see what happened in these trades. So with Google, last trade on Wednesday, the 24th of October, was $1,057.12. We looked at the expected move. That means we bought the most at the money call, bought the most at the money put, and that's right around $66, which means the implied volatility is about 90% in Alphabet, which I'll refer to as Google going forward. So we want to make sure on a skip strike butterfly that we are way out of the money, because the risk is if it goes all the way past our short strike and gets into basically the credit spread that's paying for the butterfly, getting into that spot where we skip the strike on a standard butterfly, that's where all our risk is at. Now, we're going to try to get this done for a net credit, and I would only do a skip strike butterfly for a net credit. If I can't do that, I would just do a regular butterfly. I don't want this additional risk with no additional benefit of bringing in a credit when you initially do the trade. So one thing that's very intriguing about a skip strike butterfly is that it's very possible to put the trade on for a net credit to the account, and then when you go to close it, you also receive a net credit to the account. That's one of the few strategies in option trading where you can do that if your forecast is correct. All right. So on Alphabet, we can actually go about 80 points out of the money, and that's where we're going to buy our first call option. So we're looking at the nearest expiration because we want that huge rate of time decay. We love the fact that they're going to be announcing on the 25th and the options are expiring on the 26th. And we're looking to buy one October 26th expiration, 1,135 strike call. We're going to then sell two of the same expiration, 1,150 strike calls, and then we're going to skip a strike and go to the same expiration, 1,180 strike calls, and we'll be buying that. So we're buying one, selling two, and then buying one. And we can get this done at the midpoint right now. Now, the markets are closed, so these spreads are fairly wide, of a net credit of 95 cents to the account. So this butterfly is 15 points wide. That means that because we skip that one strike, the 1,165 strike call, we are really embedding a 15-point wide credit spread into this trade. And that credit is paying for our normal quote-unquote butterfly. So in this instance, we're bringing in, for every 1 by 2 by 1, we're bringing in $95 less commission, but we're going to have a margin requirement. And that margin requirement is that maximum risk of $1,500 minus that 90 cents that, or 95 cents that is brought in. Or in this instance, it would be $14.05 is my maximum risk, or $1,405 for every butterfly that we do. Now, the expected move on Apple is $66. That's saying the market could go up or down that, and it's very possible that it could gap up or gap down that. That's the biggest scary thing about earnings, is that huge gap up. We are going exactly from where the stock closed to the first strike. That is 75 points out of the money. And then that's where the trade gets interesting. If the market were to open that 78 points and open right at the long strike, the first strike that we're buying, we now have a sweet spot range of approximately 30 points because that would be the range of the standard butterfly. We would want the market to stay within that. So we really need this alphabet to stay within a 108-point move. And it's a much different trade if it happens on the open, if that move happens closer to the close. We would like everything to be closer to the close. The ideal scenario would be that it went out right at the middle strike of 1,150, and it did it right at expiration. Then we could make $1,500 plus the 95-cent credit that we put on, or $95 above and beyond. Now, if we're dead wrong and Alphabet goes straight down, guess what? We make 95 cents. Everything expires worthless, and we make 95 cents. Our ideal scenario on any type of skip strike butterfly is that, let's say it moves up half of the expected move, or approximately the expected move, between, let's call it 30 to 60 points, and then starts drifting towards our short strike. That allows us the ability to trade out of it at any point in time. And if you ever get to the point where it's going to go on beyond your short strike, I think you just want to get out of the trade. You have one full day of trading. Time decay is going to be very huge, but this market, the way it is, it could go against you extremely fast. So if the market opened up, and let's say it opened up all the way up to the short strike of our skip strike butterfly, 1,150, you just want to close. You don't want to take this risk. You have open-ended, 15 points of risk. It's not open-ended, but you have a lot of risk if that market just continues on up to the upside. And as I said, today, Alphabet was down 57 points. That's almost the expected move by itself. And so we definitely know that it could make a 120, 150 point move tomorrow after earnings. Okay, so that's the first skip strike butterfly that we're doing it to the upside in Alphabet, i.e. Google. GOOGL is the symbol. Now, Amazon. So let's go the opposite direction on Amazon. Amazon is a higher price stock. It's almost $600 more than Alphabet. Today it closed at 1,664.20, and this also was down almost the expected move. It was down 104.50 on the day. Looking at Amazon, the most at the money long straddle, buying the put, buying the call at the 1,665 strike. That is currently trading for $120. So the expected move is $120 in Amazon after earnings. Now, remember, when we say expected move, that is just basically the line in the sand. The marketplace is saying this is what we could see happening. Now, either you could go under the expected move or over the expected move. Where do you got? But bottom line is we're setting the line right there. And that's based off of the order flow that has came in. The volatilities are just taking everything in the marketplace. The long straddle just kind of gives you a hint what a potential move might be in Amazon after earnings. So In Amazon, we can get quite a bit out of the money, especially on the downside. And here's one of the biggest things is I'm a little bit more nervous to do these type of trades to the downside than I am to the upside, mainly because stocks just in general can have a tendency to go down faster, a lot faster than they can go up. But we're trying to learn here, and we want to have a bear trade and a bull trade next week to review. So here's our skip strike butterfly using puts. We're going to look at the October 26th expiration, just like in Google, and we're going to buy the 1,500 strike put. We are then going to sell two of the same expiration, October 26th, 1,480 strike put. Then we're going to skip the normal butterfly strike of 1,460, and then we're going to buy the 1,440 strike put. This allows us to get this entire trade done for a net credit of 75 cents to the account. And you might have noticed we went 20 points wide on Amazon as opposed to 15 points wide on Google. Part of the reason why is that Amazon's a $1,600 stock versus a $1,000 stock, and it affords us that ability to go a little bit wider. That means we have an extra 5 points of upside on the maximum, but also we add an extra 5 points of risk on that credit spread that we're selling to pay for the butterfly. So in this instance, the maximum that we can make is 20 points plus the 75-cent credit, or $20.75. And the maximum that we could lose is 20 points minus the 75-cent credit, or $19.25. That will be a margin requirement that has to be held out in this scenario. That's the maximum risk of the trade. And if we do it much the same on Google, if we are dead wrong on our forecast and the market goes straight up, well, we can make the 75 cents. On the way down, we are 164 points approximately out of the money. The expected move is 120 points. And we also have a wider sweet spot because we did a 20-point wide trade, and that sweet spot is 20 points. So ideally, depending on the time of day that the move happens, if we're closer to expiration, as long as Amazon does not go down more than 204 points, which is the out of the money amount plus the sweet spot, we're going to be okay on this trade. Now, once again, it matters a lot if that move happens, if they get a 200-point move on the open, or if you have a 100-point move on the open and it slowly keeps going down all the way to expiration. At expiration, it's down 200 points. So that would be a much different scenario. Obviously, we would like it to open and slowly drift towards our short strike, allowing us to trade out of the trade at some point in time. So very interesting trades in that when you're doing skip strike butterflies, the delta of the trade, depending on how much time premium are in the option contracts, can go from positive to negative to positive to negative. Like it can go back and forth, even though the market is going in the direction you want it to. It's a very schizophrenic type option trade, which makes it very interesting and very fun to talk about here on Options Playbook Radio. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. That's the options with an S, guy at invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you've sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.